Welcome to the Trading Stocks Mastery course. I'm Stuart and I will be your teacher in this journey towards becoming a successful trader. Let's start by discussing what you can expect as you embark on this exciting career path. To become a trader, you need to learn various technical analysis concepts such as candlestick analysis, support and resistance levels, relative strength and weakness, Fibonacci retracement levels, discernible patterns, and indicators. But that's not all. You also need to have a solid understanding of risk management, money management, and trade management. Additionally, you need to develop the right mindset, which includes knowing trading psychology, having integrity, self-discipline, an adaptable mentality, and a stable mental stress tolerance. These are the fundamental skills and attitudes that every trader must possess. But as you enter this business, there are several other things that you need to consider. For example, are you properly capitalized? You'll need a minimum of $1,000 to start trading properly. But beyond that, you need to commit to this business for the long run, typically for at least 6 to 24 months. You also need to assess how much time you can dedicate to trading. Are you available during market open and market close? Are you willing to invest at least 2 hours, 6.5 hours, or 8 hours per day? It's also essential to set realistic expectations for yourself. How much do you expect to make per year? What is a realistic annual percentage return? What is the current market condition and how will it affect your trading strategy? Are you patient or impatient? Do you want to intraday trade or swing trade? Finally, once you have learned all the necessary skills and assessed your capabilities, it's time to put your plan into action. Remember that trading stocks is not just a job, it's a business. You need to approach it with a clear strategy, a solid plan, and a disciplined mindset. With that said, I hope that this course will equip you with everything you need to succeed as a trader. Thank you for joining me, and let's get started. Let's talk about technical analysis, a crucial method used in evaluating stocks. Technical analysis is a method of evaluating stocks by analyzing statistics generated by market activity, such as past price action and volume. Technical analysts use charts and other tools to identify patterns and trends that can indicate buying and selling opportunities. Another method of evaluating stocks is fundamental analysis. This method looks at a company's financial and economic metrics to determine its value. While fundamental analysis focuses on a company's underlying value, technical analysis is more concerned with the market's perception of that value. Now you might be wondering, why is studying technical analysis important? The answer is simple. We are concerned only with the information on the charts. The information on the charts provides all past price action, and past price action contains the most useful evidence to predict future price movements. The perception of a stock is ultimately what will determine the past, present, and future price of a stock. The 4 stages of the market are driven by perception, which relies on the trading psychology of the masses. It is the trading psychology of the masses that forms the perception of the market, which ultimately causes buying and selling to take place in the market. To summarize, technical analysis is a method of evaluating stocks by analyzing past price action and volume using charts and other tools. Understanding technical analysis is crucial for traders as it provides valuable insights into the market's perception and trading psychology of the masses. which can help predict future price movements. Here we have another quote by John McGee that I think nicely summarizes trading strategy. While you are following any set of rules and policies, follow them to the letter. It is the only way they can help you. If you do this, you will have certain large advantages right at the start. A. You will never be caught in a situation where a single stock commitment can wipe out your entire capital and ruin you. B. You will not find yourself frozen in a market that has turned against you badly, with a large accumulated loss and your capital tied up, so that you cannot use it in the reverse trend to make new and potentially profitable commitments. C. You can make your decisions calmly, knowing exactly what you will be looking for as a signal to take profits, and knowing also that your losses, at the very worst, will be limited to a certain definite amount. All of this means you will have peace of mind. Now we will be discussing the 4 stages of the market cycle, which can provide valuable insights for traders. The market cycle consists of 4 stages. The first stage is ambivalence, the second greed, the third indecision, and the fourth fear. In stage 1, there is minor interest with minor price fluctuations. The market is not yet showing any clear trends, and there is a general sense of uncertainty. In stage 2, there is major interest and a clear upward trend is evident. This stage is characterized by buyers who are eager to enter the market and buy stocks. Stage 3 shows no indication of a trend with major price fluctuations. The market is indecisive and unpredictable during this stage, and traders are often unsure of what to do. Stage 4 shows major interest with a clear, often climactic, downward trend. This stage is characterized by sellers who are eager to exit the market and sell stocks. It's important to remember that the market is always in one of these 4 stages, and the length and intensity of each stage can vary greatly. The market may not always follow a linear path, and the order of stage transitions can vary. Understanding the market cycle and the 4 stages can provide valuable insights for traders. By recognizing which stage the market is in, traders can make more informed decisions about when to buy or sell stocks and how to manage their trades. Welcome to Chart Basics. In this section, we'll be focusing on one of the most common types of charts used in stock trading, the candlestick chart. So what is a candlestick chart? A candlestick chart is a type of price chart used in technical analysis that displays the high, low, open, and closing prices of a stock for a specific time frame. To understand a candlestick chart, you need to know some important concepts like candlestick analysis, which involves the implications that various individual candlesticks indicate in the context of how, when, and where they occur with other candlesticks. You also need to know about trend lines, which are upward or downward candlestick formations that form a trend in an upward or downward direction. Additionally, understanding support and resistance levels is crucial. These are areas of past price action that indicate a major or minor level of commitment from buyers or sellers. Finally, linking multiple time frames together to formulate a more or less bullish or bearish bias is known as multiple time frame analysis. By understanding these concepts, you'll be able to interpret candlestick charts and make informed decisions about your trades. Here we have another quote by John McGee. It is not the chart itself, but its interpretation that is important. This highlights the importance of the knowledge which you behold when interpreting a chart. Two different traders can look at the same exact chart and have different interpretations based on the knowledge of the concepts that they behold. So how do we read a candlestick chart? Here we have a chart for the QQQ on a daily time frame. Let's take a closer look at the chart and explore some key concepts that can help you understand the price action. Firstly, notice the single candlestick outlined on the chart. This candlestick represents the price action for a single day, displaying the opening, closing, high, and low prices. Next, let's look at the upward trend line outlined on the chart. This is a diagonal line connecting the higher lows on the chart and indicating an upward trend in the price. Moving on to the support area outlined on the chart, we can see an area of price action where buyers have previously stepped in and prevented the price from falling further. Lastly, we can see a resistance level outlined on the chart, indicating an area where sellers have previously prevented the price from rising further. We will go in depth into all of these concepts in the coming lectures. For now, we introduce you to some concepts that will be necessary to reading a candlestick chart. Let's discuss candlestick analysis. Candlestick analysis is a tool that helps traders analyze the implications of individual candlesticks in the context of how, when, and where they occur with other candlesticks. Each candlestick forms for a specific time frame, such as 5 minutes, 15 minutes, 60 minutes, daily, weekly, etc. The time frame represents the length of time for each candlestick to form. For example, a 5-minute time frame represents 5 minutes per candlestick. A candlestick chart consists of red and green candlesticks, where the red candlesticks open higher and close lower, and the green candlesticks open lower and close higher. The open represents when a candlestick began forming, and the close represents when a candlestick stopped forming. Any price movement can occur between the high and low of a candlestick, which is known as the range. By understanding candlestick analysis, traders can make more informed decisions. In this slide, we'll go over the types of candlestick formations and their implications in candlestick analysis. First up, we have the wide range bar, which is a bar that is 2 times or greater in size relative to the previous 30 plus bars. This bar indicates a significant increase in buying or selling pressure depending on the direction of the bar. Next, we have the narrow range bar, which is a bar that is below average in size relative to the previous 30 plus bars. This bar indicates a decrease in buying or selling pressure, which could lead to a reversal. Moving on, we have the bottoming tail bar, which is a single tail at the bottom of the bar. This bar typically has a bullish implication, indicating that buyers are stepping in and pushing prices higher. Next, we have the topping tail bar, which is a single tail at the top of the bar. This bar typically has a bearish implication, indicating that sellers are stepping in and pushing prices lower. Lastly, we have the doji bar, which has double tails and a narrow range between the open and close. This bar indicates that the buying and selling pressure is roughly equal and could lead to a potential reversal. Understanding these candlestick formations is crucial in identifying potential buying or selling opportunities in the market. However, the implications of candlesticks do not happen in isolation, but rather in the context of other candlesticks. We will begin to cover this in the next slide. In this lecture, we will discuss how to analyze buying and selling pressure in candlestick charts. We'll also talk about different types of candlestick formations that indicate bullish or bearish sentiment. When analyzing buying and selling pressure, we look for shifts in sentiment. If buying pressure is increasing, the market sentiment is becoming more bullish. Conversely, if selling pressure is increasing, the market sentiment is becoming more bearish. Let's take a look at some bullish and bearish candlestick formations that indicate shifts in buying and selling pressure. Looking at the top of the diagram in green, we can see that buying pressure is shifting from less bullish to more bullish. Looking at the lower part of the diagram in red, we can see that selling pressure is shifting from less bearish to more bearish. Referring to the top of the diagram again in green, we can look and analyze each of the bars. Looking at the first bar, we have a topping tail bar that opens at the low and closes slightly above the open. Next, we have a doji bar that opens above the previous bar's close. The next bar is a doji bar with a wider range that closes above the previous bar's close. The next bar is a bottoming tail bar that opens and closes above the previous bar's close. And lastly, we have a full bar that opens at the low and closes at the high. This is showing bullish buying pressure increasing. Now referring to the lower part of the diagram in red, we can look at each of the bars and analyze. The first bar is a bottoming tail that opens at the high and closes slightly below the open. Next, we have a doji bar that opens below the previous bar's close. The next bar is a doji bar with a wider range that closes below the previous bar's close. And the next bar is a topping tail bar that opens and closes below the previous bar's close. And lastly, we have a full bar that opens at the high and closes at the low. This shows bearish selling pressure increasing. By understanding these candlestick formations, you can identify shifts in buying and selling pressure. On this slide, we will be discussing the context of bars and candlestick analysis. The implications of individual bars are evaluated based on the type of bar, the level of buying or selling pressure, the depth of penetration, and the volume. Firstly, the depth of penetration is the percentage of depth that a current bar penetrates into a previous bar. The higher the percentage of penetration, the greater the statement, and the lower the percentage of penetration, the lesser the statement. Secondly, volume refers to the number of shares of a stock traded during a given time frame. We will now look at some examples below to help us understand the concepts we have discussed. Looking at the first example on the left, does this formation look bullish or bearish? Feel free to read one or both of the hints if needed. Pause the video here and take time to reflect. Now that you have taken the time to reflect, if you analyze this formation as bullish, you are correct. The second bar penetrates the first bar 100%, but the third bar penetrates the second bar 0%. The third bar indicates the highest commitment from buyers. The combination of these bars represents a bullish formation. Now let's move on to the second example. Does this formation look bullish or bearish? Again, feel free to read one or both of the hints. Pause the video here and take time to reflect. Okay, now that you have taken time to reflect, if you analyze this formation as bearish, you are correct. Each preceding bar from the first bar has a lower high than the previous bar, and the third bar indicates the highest commitment from sellers. The combination of these bars together represents a bearish formation. Moving on to the last example, does this formation look bullish or bearish? Again, feel free to read one or both of the hints if needed. Pause the video here and take time to reflect. Okay, now that you have taken time to reflect, if you analyze this formation as bullish, you are correct. Similarly, if you analyze this formation as bearish, you are partially correct. The first bar is the least bearish bar, but is a bottoming tail bar. The third bar has a lower high than the second bar and a slight topping tail. The reason this formation is more bullish than bearish is because each of the preceding bars has a higher low. By evaluating the context of the bars, we can gain a better understanding of the buying and selling pressure in the market and make more informed trading decisions. In this slide, we'll be discussing trend lines and their significance. So what exactly is a trend line? A trend line is a candlestick formation that indicates the direction of the trend, either upward or downward. It's a useful tool in analyzing the market trends and making informed trading decisions. Trend lines can be identified by two or more pivots with higher highs and higher lows, which form an upward trend line, or two or more pivots with lower highs and lower lows, which form a downward trend line. Once identified, trend lines contain several properties such as upper and lower bounds that form a channel with a range of where a given stock is traded. Additionally, they may also have secondary trend lines that are nested within primary trend lines. Furthermore, pivots that form trend lines have an angle of retracement and a depth of retracement. The angle of retracement refers to the angle by which a pivot pulls back before continuing in the direction of the trend. The depth of retracement, on the other hand, is the depth by which a pivot pulls back before continuing in the direction of the trend. In conclusion, trend lines are a powerful tool in candlestick analysis as they help traders identify the direction of the trend and make informed trading decisions based on that. Here we have the same chart referred to earlier, a daily chart on the QQQ showing an upward trend line. Looking at the primary trend line, we can characterize the upward trend line by identifying two or more higher highs and higher lows. Similarly, for the secondary trend line, which is nested within the primary trend line. Both the primary and secondary trend line have a trading range with an upper and lower bound that makes up a channel. Similarly, we have a chart here showing a downward trend line that is characterized by two or more lower highs and lower lows. Support and resistance levels are important concepts in technical analysis. They help traders identify potential levels of buying or selling pressure that could influence the direction of a stock's price. Support levels are areas where buyers have previously shown a willingness to buy a stock, preventing it from falling further. Resistance levels, on the other hand, are areas where sellers have previously sold a stock, preventing it from rising further. To identify support and resistance levels, traders look for areas of past price action where the stock has bounced off a level multiple times or where the level has previously acted as both support and resistance. These levels can be major or minor, depending on the amount of buying or selling pressure at that level. Support levels and resistance levels can be linked together with trend lines. Upward trend lines can be drawn connecting two or more pivots with higher lows, while downward trend lines can be drawn connecting two or more pivots with lower highs. These trend lines can be used to identify potential areas of support or resistance, as well as to determine the strength of a trend. When a trend line intersects with the support or resistance level, it can indicate a potential reversal in the trend or a continuation of the existing trend. Here we're referring to the same chart as earlier, a daily chart on the QQQ. As we've already identified, this chart is in a clear upward trend. We've identified multiple areas of major and minor support and resistance. And as you can see, major areas of resistance that were the ceiling become major areas of support that is the floor. In this slide, let's discuss multiple time frame analysis. When analyzing multiple time frames, traders can gain a better understanding of the overall market sentiment and identify possible trends or changes in direction. By linking multiple time frames, traders can get a more complete view of price action and formulate a more informed decision. Multiple time frame analysis allows traders to access more information on a higher time frame by drilling down to a lower time frame. The lower time frame bars construct the higher time frame bars, and the lower time frame will always yield to the higher time frame. Let's take a look at the example below. So on the left we have a 60-minute time frame. Looking at the first bar, that 60-minute bar outlined, we can see that it's made up of 4 15-minute bars. Now you'll notice the first 60-minute bar is quite a bullish looking candlestick formation. And similarly, the 4 bars that make up the formation on the 15-minute time frame also follow a bullish structure. Now looking at the first bar on the 15-minute time frame, we can see that that candlestick formation looks quite bearish. And similarly, the 3 5-minute bars that make up that 15-minute bar also look quite bearish. By analyzing multiple time frames, traders can get a better sense of the overall market sentiment and make more informed trading decisions.